Smart Beta ETFs can give you far greater investment returns than traditional index tracking ETFs. They do this whilst offering lower ongoing charges than actively managed funds, and therefore they give you potentially the best of both worlds.
In this video, we're going to look at what a Smart Beta strategy is, some of the different types, and even look at 3 of the best Smart Beta ETFs. Let's check it out. Welcome to Money Unshackled, the investment channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, be sure to hit the like button and click subscribe.
Also, if you want to support the channel and get rich in the process, then check out some of the affiliate links in the description below. We've listed loads of cool stuff that will help you become financially free, including £100 bonuses if you join up to one of the P2P platforms. Let's get into it.
What is Smart Beta? Very briefly, an actively managed fund is run by a fund manager who will choose the investments that they believe in, often following a fund objective. These are often more expensive than passive funds because you are paying the salary of a fund manager and for all the work that goes into finding and managing these companies. Fees typically are within the range of 0.7% to 1.5%.
By contrast, a passive or tracker fund won't have expensive fund managers. Instead, they'll just track the market, which means they often come at a much lower fee. These funds will never beat the market, but their fees will often come in as low as between 0.1 and 0.2%.
The smart middle ground. There seems to be a gap in the middle for investors who want a semi-passive, low-cost approach to investing with the chance to beat the market. Say hello to Smart Beta funds, which might have fees ranging between 0.2 and 0.4%.
Smart Beta funds work in a similar way to a tracker, but they differ as they don't just blindly follow an index. Each fund will set its own rules, which is known as its strategy, which determines which shares it buys. Most indices are weighted based on the market capitalisation of the companies, whereas a Smart Beta ETF will systematically choose the companies that it invests in based on certain behaviours and metrics.
Smart Beta strategies. There are loads of different strategies or factors, but some of the most popular are equal weight, low volatility, momentum, quality, value.
Equal weight buys the same weight in every stock. This is one of the simplest strategies. It's a popular one because it gives greater diversification and buys more of the smaller companies than a traditional market capitalised weighted index. These might perform better than the larger Goliaths.
Low volatility weights stocks based on past volatility. Again, this is a very straightforward approach as it is easy to measure a stock's volatility. This might favour investors who can't stomach large swings or believe that less volatile stocks perform better.
Momentum weights stocks based on recent price performance. Another popular strategy, as many investors believe in momentum, which means that if a stock performs well in the short term, it is likely to continue.
Quality. This weights stocks based on strong financials. This might be a strong balance sheet or consistent earnings, just to name a couple.
Value. This is based on whether a stock looks cheap. This might be based on profitability, low multiples on book value or earnings, operating cash flows, and so on.
Now that we've covered the basics, here are the best 3 Smart Beta ETFs in no particular order.
Number 1, X-Trackers FTSE 100 Equal Weight ETF. This one I personally own, and it invests in the FTSE 100 constituents in equal amounts, so that would be 1% in each business. The ongoing charges figure is just 0.25%, but it has to be said that this is more than a traditional FTSE 100 ETF.
This graph shows the performance since the fund's inception date. It has managed a total return of 26.5% in almost 4 years, which isn't great, but not bad either. That's about 6 to 7% a year on average. We would expect this fund in future to outperform the normal FTSE 100. Only time will tell.
Similar to the normal FTSE 100, this has a high dividend yield of 4.13%, but sadly this ETF only distributes its money to the investors once per year. It's also interesting to note that X-Trackers are very transparent on their information page, detailing the additional transaction costs. The fund has additional transaction costs of 0.111% on top of the ongoing charges figure. Don't be alarmed by this. All funds incur additional transaction costs, but most have been very secretive about those charges in the past.
Number 2, Xtrackers S&P 500 Equal Weight ETF. Another favourite of ours and another equal weighted ETF. This one invests equally in the S&P 500 companies. No matter where you live, everyone should have exposure to the US market.
This comes with a 0.25% ongoing charges figure, and the distribution yield is 2.25%, which is representative of the wider S&P 500 index. The price earnings ratio of this ETF is 15.5, which is much higher than the FTSE 100 ETF that we just discussed, which was 12.6.
Does this mean that it is overpriced? Probably not. The S&P 500 is full of tech companies which are likely to grow earnings faster than FTSE 100 companies.
Let's quickly take a look at the performance graph over the last 5 years. It has managed a total return of 56.75%, which is pretty good. Remember, past performance is not a guarantee or even a reliable indicator of future performance, but for some reason, everyone still wants to see it. By the way, that blue line is just the date that two funds were merged into one and can be ignored.
Number 3, Global Value Factor ETF. We mention Vanguard a lot on this channel, so it's only right that we mention at least one Vanguard ETF. The fund will primarily invest in stocks from the FTSE Developed All Cap Index and the Russell 3000 Index that meet its requirements.
They will have lower prices relative to their fundamental measures of value. This means, in layman terms, they invest in cheap stocks. As at the end of March 2019, the fund holds 1,279 stocks and has an ongoing fee of just 0.22%. The price earnings ratio of the fund is just 10.1, which is what we would expect from a fund seeking out the value plays.
It is interesting to see that the majority of the fund is invested in financial stocks and barely any in technology. This is probably expected considering financial stocks, even to this day, are still bruised from the financial crisis of 2008. Technology stocks, on the other hand, are at crazy high valuations and therefore would not meet the fund's value rules.
If we look at the historical performance since inception, we can see that it has managed to return around 30% in 3.5 years, which isn't bad going.
We wanted to cover a lot more, but in order to keep this video as concise as possible and hold your attention, we've had to keep things to a minimum.
If you want us to cover more and perhaps give you lots more investment ideas around Smart Beta ETFs, then let us know in the comment section. We have lots more exciting information to share with you. Just let us know.
Question of the day: will you be investing in any Smart Beta ETFs? And if so, which ones? Tell us in the comments.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.